My video is on, so you cannot see me,
Yeah,
sir?
no, just start off, please.
Yeah. Can you see me, sir, now? It's fine, right?
No, you're live, Unnati.
A very warm welcome to all our viewers to the 20th edition of Cedrus Knowledge Series. This series is a knowledge sharing platform initiated with an objective of helping our investors to take informed decisions regarding the various asset classes. Coming up is a short video of Cedrus Wealth Partners. For our 20th edition, we are very happy to have with us once again Mr. Sankaran Naren. Mr. Naren is well recognized in our industry, and actually speaking, he requires no introduction as such. But for our viewers, we'll play a short video to give a glimpse of his achievements. A very warm welcome, sir. It's an absolute pleasure to have you with us once again for the sequel edition. And I'm sure we all are looking forward for your candid views and perception on the equity markets in the current scenario. For our viewers, this is a moderated session wherein we will ask our set of questions to sir. And meanwhile, if you all have any questions, you all can post it in the comment section. We will be happy to take them at the end of the session. And now I would like to hand over to Mr. Nilesh Bajaj for taking the discussion forward.
Thank you, Unnati. Welcome, Naren, once again for the 20th episode of Set This Knowledge Series. Uh, Good evening to all our audience. Your support has motivated us and to bring to you relevant topics and experts on monthly basis. And I'm sure they have guided us in your wealth generation process. Uh, Naren, you were with us last year, in last June, in fact, and when the markets were rallying, there was a optimism everywhere. Uh, and I would just like to share with you the recorded version of a few of his advice which he gave. So I'll just share with you a recorded version of the video and what advice he had given us about a year back. Uh, Unnati, can you share the video, please?
By wealth managers like you. It has not been caused by investors in India. This has been caused by the Federal Reserve and various central banks across the world, that they have given us no options to invest safely. So I don't think there is any choice. My guru Howard Marks says there are times when you invest when you are trying to make a lot of money. There are times when you invest when you are not sure whether you are trying to protect a lot of money. I would say that today you can't invest to make a lot of money because there are no valuations which are cheap anywhere in the world. And that is the reality at this point of time. So essentially you have to agree that you cannot aim to make too much money from here, and I mean, the way I look at it as a fund manager of equity funds or hybrid funds, that I'm looking to some extent make some small money trade. The global central banks putting $25,000 billion over the last 13 years, including a record amount of money in the last 1 year, which is responsible for this situation, giving us no choice. Because in my 32-year career, I don't think fixed deposit interest rates have come down to such a low level anywhere. Even in India, I don't make too much money. In 2007, I was trying to tell people that it's not time to try to make too much money. Maybe the downsides now may not be like 2007, but the upsides from here will come with risk. That is the reality which all investors should know. But you know what is, interest rate cycle is gone. What I mean by that is interest rates kept falling. When interest rates fall, you make a lot of money. But that phase is gone. That phase is over with last October. And I believe that in the next 3 years, interest rates are going to go up everywhere in the world. So the returns that people see in debt mutual funds in the last 3 years, you're not going to get in the next 3 years. What you will get is yield to maturity minus expense. So you will have to be aware of that. So I think, honest, at some point of time, US interest rates will go up. And when US interest rates go up, globally equity market will fall. There is nothing wrong in India. In India, no one has taken risk. No corporate company has taken risk. All of them have deleveraged. You check in any part of the country, all the corporates have deleveraged. Most of the bank NPLs have gone down because all those problems have got solved. Most of the non-banking financial companies which were in trouble, all those problems have also got resolved. Current account deficit is not high. Credit growth is not high. Capex cycle hasn't started. So if you look at it, India is not in the advanced business cycle, but US is in an advanced business cycle. So someday there is going to be a problem due to US business cycle, US interest rates, US Fed, etc. Now sitting in India, we cannot predict that. In India, you can consider. But is real estate more attractively valued than it ever was? Yes. Because mortgage interest rate has come down to record low. Because you go...
Many thank you, Naren, for guiding us with your views and word of caution which you gave last year.
Thanks.
I'm sure investors who went by your advice, they would have definitely fared better, and they are better placed today, seeing that the equity markets have corrected, interest rates have moved up, and there are geopolitical issues, in fact, which are going around. So Naren, let's take this forward as a sequel from what we asked you last year, and I think your guidance has really helped us, all of us, including me. So my first question to you, Naren, in fact, is uh, with high inflation, central bankers globally, they have been increasing rates. Uh, And do you feel, with the markets falling, Indian equities have become attractive, or there is more downside before value really comes back?
Actually, it's there's a factor which obviously we could not have predicted, which was Ukraine, and frankly, that factor is also playing at this point of time. So, if you can predict what will happen to the Ukraine-Russia war and how crude oil will move from here, and that will help actually. Unfortunately, I don't think at ICICI we know what will happen to the Russia-Ukraine war, and that is an important thing actually. If the war does not end and crude oil is going to be where it is, I don't think you can make money in equity at this point of time in a big way. It's not possible. But suppose tomorrow you call me and tell me the war is over, you can make money in equity. So it is a factor which is not controllable at the level of ICICI or anyone in India, frankly. But there is a positive which can come out of resolution of the war. But if the war were not to get completed, end, I think clearly debt is a better asset class, particularly from October. In the near term, we are believers in floating interest rate funds. But going from October, I would say debt and equity, debt is a better asset class. There will be two more rate hikes from the Reserve Bank, both in the next 1 week and subsequently in October. And then after that, debt will be a very interesting asset class for most people. And then why the gap in returns between equity and debt will be very low unless you have the resolution of the war. Whenever the war gets resolved, you will get a good return in equity temporarily. But after that, again, I feel that debt and equity will give you the same returns or not with much difference. Because in India, what happened was your investors actually bought when foreigners sold. And due to that, India fell much lesser than other countries. And therefore, Indian valuations today is much, much higher than every other country in the world. So if you look at countries like Taiwan, Korea, Japan, and not including China, because China is going through COVID at this point of time, almost everywhere in the world, markets have corrected substantially compared to India. So the upside in those countries are much higher than India at this point of time. So I think we are in a moderate return world. In after a big jump up possible due to Russia, Ukraine, and if that war doesn't keeps on going on, you're not going to get that return also.
Okay. In fact, I was reading this book, The Third Reich. This was on the Second World War. And there apparently it took about 3 years. There was a lot of activity going on, but it took 3 years for a full-fledged world war to
Sure.
happen.
We
Okay. So
don't
from
want it. We don't want a full-fledged world war. Let's be clear
yeah.
about it.
Yeah. So my question to you, and if in case if you can give an answer to it, is that do you feel that again this Russia Ukraine standoff which is going on, and we don't hear too much about it in the newspapers also nowadays. Okay, there's a small article which will keep coming, but that's all. But do you feel slowly there is something which is happening which can lead to a full-fledged world war? Like they've stopped the gas pipeline. Only 20% is getting supplied to Europe, and I'm sure Europe will freeze if gas is not supplied to them during winters. So, do you really feel it can happen, or this can just be just between Ukraine and Russia?
See, on the day the war started, I had a colleague uh, who runs my long short fund. He told that the war will go on, and most of us laughed at him. And so, we keep asking him what will happen because he always looks at such things. And his view at this point of time is that around November, the war, something will go right in the war. And
Mhm.
his belief is around November, when the US elections, midterm elections happen, he believes that something positive will come up. So if you ask him, he believes that post November, there will be a resolution just ahead of the European winter. And
Mhm.
because Europe can't handle this current situation. So if you ask him, he's positive. He doesn't believe in a World War III. He believes in a resolution over the course of the next 6 months. And therefore, from that viewpoint, I would say that yeah, you can expect returns over the next 6 months, but not necessarily returns over the next 3 months based on his view. But it's just his view. He can go wrong.
Absolutely. No, in fact, a lot of people, when this war started, were talking about World War. I think no one talks about Ukraine and Russia anymore. In fact, and what we have seen is that generally when people stop talking about something, there is something cooking up over there. In fact, so last year, like I remember you very clearly told about inflation, the risk of interest rates rising. It was there. It was there in front of us, but people didn't really talk about it. They didn't feel that there's going to be any reason why the equity markets are going to correct. Okay. So that's, I think, that can be one of the black swan which can happen, in fact, and I'm sure no one can predict that.
Yeah, absolutely. Because see, end of the day, at this point of time, the market is not cheap. The market is not in a position that basically you can say something is cheap. We are not even in a position where you can say debt is also cheap. But I would say, other than floating rate, nothing else is cheap at this point of time. But maybe now people are more alive to risk. 1 year back, if you had told people that there's risk, people used to laugh at us. Today, people are alive to risk. Market is not cheap, but people are alive to risk at this point of time. That's the difference between 1 year and now. But other than floating rate, I don't think there is any area where I can say that there is valuation is cheap. You should just go jump buy today. You are getting a big valuation benefit at this point of time. Some of the global markets are cheap, but then there are so many impediments today to buy global funds. Last year, everyone wanted to buy these global funds. That was the wrong time. But today, global funds, there are so many restrictions at this point of time. We have a fund of fund which you can, at least it is open, but most of the other funds are not even open at this point of time. That is a big challenge for most investors. But at least some of the global markets have corrected sharply. And
True.
in those countries, the retail investors have given up. And that's why I believe at this point of time, maybe global markets have bigger upside, local markets have lower upside, but in 3 months' time, I believe debt will be a very interesting asset class. And today, only floating is an interesting asset class because it's the only area where, as interest rates go up, you benefit. And surprisingly, in the last 6 months, you didn't benefit in that asset class. That's why I believe you will finally, at some point of time, you have to benefit. That is how we think.
Yeah, in fact, my next question to you was on bond yields. The bond yields have moved up to, they are above the historical average levels of, it's at around 7.5%, the 10-year GSEC. And this was anticipated. Last year, there was an anticipation that the yields will increase, the interest rates will follow, and it all has happened. It's planned out that way. And this was predominantly my next question, that would it be attractive to invest in debt funds today? And second thing is, would accrual funds, which have low mark to market, like credit risk funds, are they better options, or is it better to invest into funds like floating rate funds or a GSEC fund? In fact, for a 3-year period, if I take a 3-year period, what do you really suggest?
See, we've been looking at basically dynamic bond all seasons kind of categories at this point of time, because what we think is over the next 3 months, the shorter interest rates have to go up substantially. What will happen to longer term, we are not very clear at that point of time, but we think that in the short run, you'll make money out of floating kind of categories, and in the medium run, you'll make money in all debt categories. So
Hmm.
that's why we like these dynamic all seasons kind of categories. That is what we like at this point of time. Because in the near term, most of the shorter term interest rates are going to go up. We are believers that every interest rate in the country is going to go up in the next 3 to 6 months. And that is
Hmm.
what we're seeing at this point of time. Most of us have to forget that 2020 and 21 interest rates are not going to remain. And those people who have loans should be very, very conscious at this point of time. Find a way to repay the loans. That's my suggestion. If you are borrowed, it is not wise to believe that you got rates at very, very low levels. I think every borrowing is going to become costlier over the course of the next 6 months. And it is very important not to have borrowing, in my opinion, if you are an investor. And that is something I think people haven't realized, that 2020 and 21 were teaser rate borrowing. You are not going to have it in 23 and 24. In 23 and 24, when you see the borrowing rates, they're going to be very different from 20 and 21. It's very important not to have borrowing first. And that is very, very important. A lot of people think that I got a very cheap borrowing cost. That borrowing cost, particularly if it is floating, it will start going up. That's why we like floating as a category, because floating will benefit when it goes up. But if on the other hand, if you're a borrower, you're going to be hurt in the course of the next 1 year. So one of the messages I tell everyone is, you have a floating rate borrowing, please repay it as quickly as you can. Don't worry about anything, just repay that loan. Don't have any borrowing linked to floating at this point of time. If you have an investment linked to floating, no problem. But if you have a borrowing linked to floating, please repay. That's the message I've been trying to give everybody at this point of time.
No, I'm sure, and most of the home loans are floating rate, in fact.
Yeah.
Yeah. In fact, last time you had mentioned that you should expect a return of YTM minus expense in case of debt funds if anyone invested last year. Does that hold true, or do you feel that there is an element of capital gains also if someone invests for a 3-year period?
See, in the very near term, it holds good. But I believe that, today we are in July. But, once you move to that October, November, December phase, I think at that point of time, I think things are going to change. So in the near term, we are still believers only in floating, and that's why dynamic bond or all seasons. But I believe that once we move to this October, November, December phase, I think that will become a very interesting asset class. So maybe we should touch base in October, November, December, wait for 2 rate hikes. You have to look around the Diwali season and then have that conversation, because right now it may still be, we are still in an increasing rate environment, but that may not be the case starting November. That's my current view at this point of time. And that's ICICI's view at this point of time.
Okay, wonderful. Most of the problems in India, be it high bond yields or high inflation rates, these are, most of the experts say they are imported problems. India domestically does not look that bad. And in fact, the corporate earnings also, the numbers which are coming, after a very long time, we have seen very good earnings growth from corporates. And so do you feel India will be, the worst is over for India, which you have told that, you don't feel the worst is over. But do you feel India will bounce back faster in case if things turn out to be better and the Indian economy will do better?
See, I think if we take a 5 to 10 year view, that is certainly true. And but if we take a situation till the resolution of the Russia-Ukraine war, and till oil is sitting at this current price, I think once oil comes to this $80 phase, I think then after that we can be very, very confident of India doing very, very well. But oil has to first move out of this $105 phase to this $80 phase. One of the questions people keep asking, would you have lost the opportunity then? But in history, I have never seen a situation where oil has corrected from 100 to 80 or 70 and equity markets have delivered returns. So I would say whenever oil has fallen $25, it has always been when markets have gone down. So maybe it can happen this time because of Ukraine war. That is why I tell people that if you have a clear view on Ukraine war, you can be a very good equity investor. And I don't have a clear wall on Ukraine war because I also read the newspaper and comment as though I'm an expert, but I'm not an expert. But if in any other way, I think the oil is a big challenge at this point of time. And at $105, even if earnings come better, there is some other problem in some other part of the economy which we are not recognizing. And that is the challenge at this point of time, which we also need to recognize. And that is where the problem is coming. Does it change the 5-year structural story? Answer is no. And the 5-year structural story is still good. But as I've been saying, I think in 2-3 months' time, debt is also going to be an interesting asset class. And therefore, you can play the structural story and you will get decent returns in debt also. It won't be like what it was in 2020 and 21. So you're going to get opportunities to play in debt. You're going to have opportunities to play in equity. And that's why you're going to have opportunities everywhere. And that is how we see it. But till crude oil comes down, I would not take that call that we are in a very, very big structural positive environment. And that is something I would still be more careful about at this point of time. Of course, the Fed is another reason where the Fed is still in a very, very hawkish view. And suddenly, over the last 1 month, people are not worried about the Fed. I'm not able to understand that. And we are trying our best to understand why the mood has become very, very comfortable on the Fed. I'm not being able to get a grip on that. But I would still say that, when you're printing money, that money leaks to all parts of the world. And now they are not printing money. And because they're not printing money, I think that is again a negative for all emerging markets. Having said that, I will say that the Indian macro has been brilliantly managed by Indians. I would say that the Indian government has handled it very well. The Reserve Bank has handled it very well. And that's why, despite oil being at $100, we don't have any macroeconomic crisis. Look at the number of countries which have macroeconomic crisis at this point of time, and you'll find that India does not have any problems whatsoever. That's the positive, and that is the reason why we think that you can be comfortable in financial assets. There are so many countries in the world today where you can't be invested in financial assets, primarily because the macro has been handled very badly by the government or the central banks in those countries. And I would say that's the positive, and that's the reason why you and I are able to pursue our craft, because if the central bank and the government doesn't do a good job macroeconomically, whatever we do will result in loss for our investors.
Right. In fact, that's so true. A lot of people are expecting with this equity markets going, have rebounded in the last 8-10 days, and they expect that this is something where the worst is behind us. This is what most of the investors ask us: is the worst behind us? Or and we at Cedrus also recommend that there is going to be volatility. So this can be a one-off kind of a bounce back, but it's more to do with short-term nature of investments than actually in the long term. You can expect till the Ukraine war does not get over, there can be issues. In fact, in the equity markets. In fact, now Naren, coming to from equity, debt, and we have spoken about the economy. Coming to we discussed about this category which is not doing well last June, and this was the value category, whereby we had discussed that value, would it make a comeback, in fact. And very clearly, if you see your ICICI Approved Value Discovery Fund has been one of the best performing funds in the last 1 year. In fact, it has helped people fall less. So do you feel value as a category is going to continue doing better, or because there is a good margin of safety in those stocks?
See, if you look at it, the category was launched by us in 2004, and over the 18-year period that we have now seen, the category has done very, very well, with periods in between where it has not done well. Our view is simple, that as long as you're willing to be having a longer term outlook, I think the category will do well. And if you're going to continue to see environment which is going to be volatile, I think we are going to have a good period. But if you're going to have an environment where you're going to have a very big bull market, then I think whatever be the theme of that bull market, I think that will do better than value. But we still believe that there is a fair amount of volatility ahead, and we could be wrong. But so what we believe has always been that as long as you're willing to invest for the next 3 to 5 years, value always appears and is a good category for investment, and that's been our 18-year experience, and we continue to like it. But where in extreme bull markets, it's bound to fail. And that is something we still believe in, that it's going to fail in extreme bull markets. It failed in 2007, it failed in 2017. So again, we believe that it will fail in extreme bull markets. But otherwise, for the long-term investor, which I guess constitutes a lot of your customers, I don't see any problem for investment. Nilesh, I can't hear you. Are you speaking? Nilesh, are you speaking?
No, I'm not speaking. I'm listening to you. In fact,
yeah. No, I believe that
Yeah.
that is, I have a strong belief that asset allocation and value, these are two things which never go out of favor in the long term. And
Right.
in extreme bull markets, people will always ask you, why do I do these two things? That's how I look at it.
Okay. Last year you had mentioned that real estate is the only asset class which you felt there was value in it, and all the financial assets. In fact, there was not too much of value last year. Uh, Going ahead in the next 1 year, which is the one asset class where you find value? You have, I think, given that answer to that question, but we would just like to hear from you as a part of the answer to this question. In fact, that which asset class do you feel holds a lot of value going ahead?
See, normally my framework is very simple actually. The most hated asset class at a point of time is
Hmm.
normally the asset class which I call value. So the
Right.
most hated asset class among my colleagues at this point of time is floating rate. And
Hmm.
so that is the asset class which I find most value in. So it has to have bad past returns, it has to have low valuation, and it should be hated. So then I
Hmm.
like call it value. So frankly, on the that is how we look at it all the time, and it works. So
Hmm.
similarly, if there is an asset class which has done too well, 20 to 40% return, so
Hmm.
if something delivers more than plus 40% return in the last 1 year, I get damn worried. If anything
Hmm.
delivers 3 years, 20 to 25% CAGR, I get very worried. Those are
Hmm.
on the other side. Luckily, as we speak, there are no asset classes on that side where we have
Hmm.
to tell you it has done too well, so you have to be worried about it. So that
True.
luckily doesn't exist. On this side, I would say that there is clearly floating, and I believe that everyone should repay their loans. I
Hmm.
think the biggest task, if you ask me, is that your customers, no one should be leveraged.
Hmm. Hmm.
And people have this belief that interest rates are low, so I should be leveraged. I believe
Hmm.
that the most important thing, if you ask me, what is value, or
Hmm.
is that you should repay. You should have, no one should have a loan. So if you
Hmm.
have a loan and an investment, I tell people repay your loan by
Hmm.
selling your investment. Be
Hmm.
non-leveraged at this point of time. That is the most value thing I can recommend at this point of time. Do
Hmm.
not have any leverage in any asset class at this point of time, because I am
Hmm.
fearing that interest rates will go up in the next 1 year. And at that point of time, I don't want people to have any borrowing. And that is my biggest worry at this point of time.
No, this is a wonderful suggestion actually, and again, your candid views, which generally help investors. This is one of the views which is something which I am sure people were not expecting. Uh, but very clearly, what you have mentioned is that it's better to stay invested in a floating rate debt fund and repay back the floating rate loans which you are having on your home loans.
Exactly.
So, Naren, now, one question to you with a 3-year time horizon. Okay. Last year, I think, equity savings did pretty well, specifically your equity savings, which is a more conservative equity savings fund because you do not take too much of equity exposure. Okay. Now coming, 1 year ahead now, okay, with interest rates already rising, they've risen, and they are expected to rise, but the yields have already risen in anticipation, and the equity markets have fallen. Okay, so do you feel for a 3-year period, okay, equity saving is a better concept to, on a risk adjusted basis, on a purely risk adjusted return basis? Do you feel a equity savings is a better concept for a 3-year period, or you can say medium term debt fund kind of a strategy? Okay, on a purely risk adjusted basis. Okay, what do you feel, for a 3-year time horizon with markets falling and interest rates rising, which will be a better option to invest?
Right now, I'm in favor of dynamic bond all seasons kind of category at
Right.
this point of time over equity savings. If you look at the returns in arbitrage funds, they are too low. So the
Mm-hmm.
arbitrage part of the equity savings is delivering too low a return. So that is giving me irritation at this point of time. So that's
Mm-hmm.
why any day I would say that a dynamic bond all seasons kind of category is what is most interesting, because I believe that the next 5 years belongs to debt. And
Mm-hmm.
if you look at your customer base, the quantum of money that would be invested in debt would be
Mm-hmm.
very, very low as a percentage of AUM. Somehow I'm
Mm-hmm.
very confident about that without knowing anything. I've not
Uh,
spoken to anyone, and without speaking to anyone, I have that view. So, I believe that, somehow I have to get people like Cedrus's customers to have a very big component of money in a dynamic bond, all seasons kind of category. In the last 10 years, one of the
mm-hmm.
things which we popularized a lot was
Mm-hmm.
the balanced advantage kind of category. And that was the category which we popularized today, that every mutual fund has started the category. Now, I think the
Mm-hmm.
next 10 years belongs to a dynamic bond, all seasons kind of category, in my opinion. And I
Mm-hmm.
believe that when people, always the pioneers are the biggest winners. So if you look at it, people who invested with us 10 years back in balanced advantage or multi asset kind of constructs, they were all benefited. I believe this is the category which I'm most convinced about for the next 10 years. Because I
Mm-hmm.
think, what people have to recognize is for the last 12 years, or the last 14 years, 13 years, the Fed actually supplied liquidity to the world. The global central bank supplied liquidity to the world. Because the
Right.
global central bank supplied liquidity to the world, what happened was debt was not a great asset class in emerging markets. In my
Mm-hmm.
opinion, till the day Fed again says, I am going to be the supplier of liquidity to the entire world. And if that situation were to again arise, I'm sure we would again, Gaurav will again reach out to you. I believe debt is a great asset class. So
Mm-hmm.
it is just because the central banks decided to provide liquidity to the entire world that debt was not a great asset class. Now,
Mm-hmm.
the central banks are not providing liquidity to the world. And that is the
Mm-hmm.
reason I believe debt is going to be a great asset class for Cedrus's customers. And people
Mm-hmm.
don't think that way. And that is the important thing that people have to get used to, that they should invest in debt. And many of these fixed rate products, if you go back and look, 5 years, 10 years back, particularly in 2013, a lot of people could invest in 10-year tax free. All those products are no longer in existence. So today you have to, that the first series of 10-year tax free, the money has even come back. So I
Mm-hmm.
believe that all that money again has gone into equity, in my opinion. So I think it's very necessary. All that 10-year tax-free money which has come back in your segment, all has to come back into a dynamic all seasons kind of category, because somewhere that 10-year money has leaked and come back into equity only, and that is not something I'm happy about. Because you go back and look at your customer base, you'll find that all the 10-year return money is not coming back to debt, it's coming back to equity or something like that. And that's my
Right.
view at this point of time.
Mhm. No, so one disclaimer, Naren, we believe in strategic asset allocation. So at Cedrus, we have about 40 to 45% of our total AUM in debt, even today, which
Amazing,
apparently.
amazing. Huh? I don't see that with other MFDs, so it is amazing. I must give you full credit, Nilesh.
No, so one thing, last year we got a lot of hammering from our investors because when the equity markets were rising, our portfolios were definitely underperforming because we had an element of debt in it. But I'm sure this year the investors are happy because they have not seen their portfolios fall the way the investors' portfolio with 100% equity have fallen. So I think
Amazing.
so as a part of an asset allocation, we'll always have debt, in fact, and in spite of debt not doing well in the last 2 years, we have yet have that allocation. And in fact, the question why I asked you specifically to this was that we did invest a lot of money last year also in debt, and there the returns have been like 2% and 3%. And investors are quite, they have that anxiety whether it's better to move out or stay invested for another 2 years and at least get that YTM minus expense kind of a return, in fact. In fact, Naren, my next question to you was exactly, what you just mentioned, the asset allocation category. And this is one of my favorite categories. And ICICI Prudential is a mother of of Balanced Advantage Fund, because you invented that product a long time back when it was not a part of the, normal plain vanilla product kind of a offering from a lot of other AMCs, in fact. So, last year also you mentioned about asset allocation as a category. It's a better category to invest in last year than to, invest into pure equity funds where the risk-adjusted return was definitely more in favor of risk, actually. But do you feel, and in this fall also, this fund has done very well. The asset allocation as a category has done very well, actually, because they have protected the investors' wealth. But do you feel that investors should look at this more as a a strategic allocation where they have a core portfolio which is invested only in this asset class, okay, and it just continues, in fact, for a longer period of time. What do you feel? Because it's an all-weather strategy.
So what we have also done actually after 2020-21 is told people to look at multi-asset. In
Hmm.
December, January, we launched a very interesting product called Passive Multi-Asset Fund of Fund.
Hmm.
These kind of strategies also one needs to look at. So if you
Hmm.
look at multi-asset, you get gold, REIT, exchange
Hmm.
traded commodity derivatives. Like for example, we are invested in silver,
Hmm.
etc. So in passive multi-asset, we are invested in almost all the countries in the world, which includes US, Japan, China, etc.
Hmm.
So you get
Hmm.
most of the ETFs of almost all the countries in the world, and it's
Hmm.
one of the rare products which is invested in every. It invests in all the ETFs, equity, debt, gold, and global ETFs. So
Hmm.
we think that you can broaden this base by also looking at both multi-asset and passive multi-asset. And
Hmm.
once you broaden this base, you're actually getting a much more interesting set of products. And
Hmm.
multi-asset kind of product can be a bit more aggressive in the longer run when the view on the market turns out to be much more constructive.
Hmm.
Let's say for example, we think that Fed is going to ease significantly. We can be much more aggressive in multi-asset, or of course there are fund manager risks in these products, but
Hmm.
it is possible that they can be slightly more aggressive products than
Hmm.
balanced advantage, and that's what I would request you to think about and have the conversations with
Hmm.
ICICI mutual fund team on these products.
Hmm. No, because the reason why I'm asking you is that, because there are a lot of investors, first time investors who got into mutual funds, and they were the typical fixed deposit investors who wanted to get, the taste of the equity markets. And they have actually had a very good, because of the track record of the Balanced Advantage Fund, they've had a good experience with this fund because they have not lost money. I think the most important thing we believe is that, as asset managers, if we are managing money, we need to see that we are managing money, we are protecting their money more than actually only giving them returns, in fact. And that is a product which has appropriately done very well over a very long period of time in all types of markets. So in fact, we
Yeah,
call
yeah.
it a all strategy. Whereas in multi-asset, like what you clearly mentioned, the problem lies with the fund management. In fact,
So
if
that's
the
why
risk,
you have first time investors, you have second time investors, you have third time investors. So
right,
you
right,
have in your customer base also, you have first time investors, second time investors, and third time investors. And
right,
sometimes people want some spice also in their products. So,
right,
and
right.
therefore they want higher riskometer products, as I call them, with higher
Hmm.
upside. So
Hmm.
that's how each of these products are unique in their own way, if you ask.
Hmm. And I'm sure, with so many range of products, the investors themselves are very confused. In fact, because you have so many
But
different
each
types
serve
of
a
products.
different purpose. Each serve a different purpose, and each of them have their own scale. actually.
Right, right. No, in fact, my last question, which you have already answered, but the only thing is I'll just frame it the other in a very different way. This galloping equity markets last year, and now we have seen the equity markets fall. So we apparently, you recommended last year to be cautious. Okay. This year also, you're expecting equity markets, investing in equities, you should invest in a cautious manner, in a more staggered manner. But where do you see the bottom in the markets? In fact, is it that the war
See,
gets over and you can go and invest, or you feel, or oil goes down to 85, or there is a bottom which we have seen a bottom of 18% from the peak. Okay, that was the bottom which we had seen. Do you feel that the markets can go down more also? In fact, after we've seen a 10-day rally in the equity markets.
See, it is possible we have seen the bottom. That's one possibility.
Hmm.
The second possibility is that we will have a actual domestic retail capitulation where domestic retail investors give up on the market. That's a possibility also. See,
Hmm.
our view is that today, where is the difference between this year and June 2021? This year, people are more conscious of risk. Because
Hmm.
people are more conscious of risk, what happens is things are safer.
Right.
Last year in June 2021, people were not conscious of risk. Today, people
Hmm.
are much, much more conscious of risk everywhere in the world. So I
Hmm.
believe that markets are safer when people are more conscious of risk. That is the
Hmm.
advantage at this point of time. And that's why I would say markets are safer today than they were in June 2021. So,
Hmm.
what is the reason for being unsafe at this point of time is actually geopolitical, because
Hmm.
geopolitical risks are not predictable on the part of fund managers. That is the
Hmm.
problem at this point of time. Otherwise, market is safer than it was in June 2021. The
Hmm.
the high return potential, always comes from valuations being cheap.
Hmm.
Unfortunately, in India, we are not having that.
Hmm.
It would be very nice for me to say that thumping the table, you'll make a lot of money. And that comes when you have very cheap valuations. Somehow,
Hmm.
thanks to good work done by Nilesh and many other people, we are not having cheap valuations. And if you had cheap valuations, it would be very nice for me to say you'll make big money.
Hmm.
That for that, I'm not having that market. So while markets are safer today than June 2021,
Hmm.
markets are not, I can't see the reason why you should get mega returns at this point of time. But
Hmm.
somewhere you are going to make better returns in debt. That I
Hmm.
think I'm more confident of over the next 3 to 5 years than what
Hmm.
you had in the last 2 years. The last 2 years have been disastrous in debt. There I'm more confident that the next 5 years returns in debt is going to be much, much more interesting. And since you said 40% of your assets under management are in debt, I
Hmm.
think that is going to be make your experience much much better, because you've seen some of the worst experiences in the last 2 years. That
Hmm.
2 year experience is not going to be repeated in the next 5 years. The next
Hmm.
5 years, that is going to be one of the most important asset classes. And
Hmm.
there I feel you're in a much much better shape than many other people, because most other people don't have this 60-40. They are
Hmm.
more like 90-10 kind of situations.
Hmm.
Therefore, they want to have more challenges, because if 10 does well, it doesn't help. Whereas I'm reasonably confident that that 40 will do better in the next 5 years than the
Hmm.
last 2 years. And that is the positive, if you ask
No, no, that's so true. In fact, and we have seen that when the debt didn't do well, equity markets helped us. And
me.
when
Yeah.
last year, in fact, debt didn't do well, but it didn't do worse than equities. In fact, and
Yeah.
that's helped people at least protect their capital. In fact, in the last 1 year. In fact, that was my last question, Naren, and it's actually. Uh, thank you very much for taking out time on a
Thanks.
Saturday from your very busy
Thanks.
schedule. Yeah.
Thank you.
Now, quick,
Thanks.
quickly, Naren, we'll only, there may be some audience questions, in fact, which Unnati is waiting for. So quickly, I'll just ask Unnati to take any question which is relevant, and then we can wind up after that, in fact, because I know that you are in a rush. It
Yeah,
was very told to me. But as always, your
maybe I can
chatting.
take up. I can make take up a maximum of two questions. Unfortunately.
No problem, Naren. In fact, anything which is relevant is what she's going to question. Okay. So maybe one or two. That's all. So Unnati, can you please go ahead?
Yes, sir. That was indeed a very intriguing session, sir. And I'm sure your views on the equity markets in these situation and your advice on the borrowed capital has helped our investors going forward. Moving to the first question from the audience, what impact will the economic and political instability have on our neighboring countries like Sri Lanka, Pakistan, Bangladesh, etc.?
I personally don't think so because, see, geopolitically, we are now today able to handle so many things so beautifully thanks to our government. So I don't think there is going to be so much of an impact. We always have to be conscious of China, and that is a bigger thing than these three countries. I think we'll have to support these three countries in various ways, and that's what we will do. So I think geopolitically, it will help us rather than hurt us.
Okay, absolutely right, sir. And what is your outlook on growth stocks in the near term scenario after looking at the high interest rates and the high inflation?
So I'm much more of a value contrarian person. So, for me, I find them still expensive, but the last 1 month they've done well. So, my view is that these stocks continue to be expensive at this point of time. One of the reasons I believe in a moderate return equity environment is because I'm not able to understand the valuations of many of these stocks at this point of time, and therefore I'm a believer in a moderate return world over the next 2 to 3 years.
Right, sir. Wonderful, sir. I think this was a very insightful session for all our investors and for us. And we would like to thank you, sir, for such a fantastic session, and
Thank
ICICI to AMC for making the time to grace this event. A big thank you to all our viewers for tuning in such large numbers and making this event a success. We will return next month with a new topic and a new speaker. Until then, stay happy, stay safe, and happy investing. Thank you, sir.
Thank you, Naren. Thanks.